Welcome to Money Talk Viewpoint. My name is Stuart Kruse. I'm going to be your host. Money Talk Viewpoint is a podcast that is geared towards servicing high net worth professionals, family offices, and those people who service that area. So like CPAs, wealth advisors, estate planning attorneys, and the like. I am founder of Kruse Asset Management. We're a quantitative boutique asset management firm. By quantitative, I mean we build and make all of our investment decisions using math and statistics. We think it's a better approach, and research suggests that it's better outcomes for long-term viability for the client. We also run a virtual family office, as you know. And by virtual family office, what that means is we collaborate in a team-based approach with your experts. So we bring your CPA in, we work with your estate planning lawyer, your insurance person, and any other outside experts that we might need in order to optimize your wealth. Now, I came from a wirehouse background. I was at Lehman Brothers and Bear Stearns prior to that. And I will say from firsthand experience, and this still goes on today, the wirehouse's compliance department will not allow their advisors to collaborate with, let's say, a CPA to provide an optimal strategy for you because they can't control them. They won't allow us to bring in other outside experts outside the firm because, again, they have no control over them. That's why if, as a fiduciary, I think it's super important to have this team-based approach so that we can help optimize your wealth. As a fiduciary, I don't know of a better way or another way to be able to provide you with the best solution possible, which is my mandate. It's not the mandate of large brokerage firms. They have to provide you with suitable options. I have to provide you with defensively the best option. And the only way I can get there is if I collaborate with outside experts. Speaking of outside experts, we have a fabulous one on your show right now, Jesse Raynes. He is from Inception Financial, and he is going to talk about, and we're going to talk a lot about this, is solar tax credits. So he's a tax mitigation specialist in that particular area. And again, from firsthand experience, I would not be able to talk to you or talk with Jesse about this on your behalf if I was at a large wirehouse. It just would not be possible. So Jesse's background is quite impressive. He was a senior VP at SunVantage Energy, which is a commercial solar firm. He spent 3 years at Solar City of Elon Musk fame, another 6 years at Tesla as a regional VP managing $600 million in residential solar market, over 8 regional directors, 60 sales managers, and 800 sales consultants. Prior to that, this could be the most interesting thing on your LinkedIn profile that I saw, president of Jimmy John's Sandwich franchise. We love Jimmy John's here in Chicago. You also have a master's degree from University of Illinois, which is my stomping grounds in Chicago. I actually got into University of Illinois engineering school, decided to go to Northwestern, so we can talk about that a little bit. Jesse, welcome to Money Talk Viewpoint.
Well, thanks so much for having me. Excited to be here.
Excited to have you. Now, before we jump into probably what everybody's interested in, that's reducing their taxes, how did you go from sandwiches to solar? Gotta ask.
Well, the sandwiches it came about because I went to University of Illinois and fell in love with Jimmy John's, and I knew they didn't have Jimmy John's out in California, so I was very passionate about bringing the brand out here, and so sort of did that in parallel amongst other things. So it was always designed to be a passive type of investment, if you will, but I can assure everyone that's listening that there's nothing passive about running restaurants. I learned that firsthand, but it was an amazing experience, great brand, great product, and obviously running any type of business, certainly at that scale at 5 locations, teaches you a lot as an entrepreneur.
Yeah, it's fantastic. We love Jimmy John's. I go get the number 5 Vito all the time. It's one of my favorite sandwiches. Did you have a favorite while you were there?
I would say the Vito was also one of my favorites, and of course, I really love the roast beef. So the Little John is probably another one of my faves.
Sounds great. All right, well, let's go ahead and jump into this. So you clearly have an extensive background in the solar energy and field. Just tell me how you kind of got into that renewable energy space and what drove you there.
It really derived from my stepfather, who was installing solar systems in Flagstaff, Arizona, going back to early 2000s. They installed one of the very first grid-tied residential solar systems on Arizona Public Service Grid in Flagstaff. And I was just always enamored by the technology. It seemed very intuitive that we would generate power from the sun. And so I just dove in head first. And at the time, there wasn't any place to learn about solar except on the internet. And I have a thirst for knowledge and learned everything I could, right down to the wire saws that cut silicon. And after that, I interviewed for a handful of executive positions, was fortunate to start with an upstart distributor that allowed me to learn who all the major players were in the space, both on the manufacturing side as well as the financing side. And then shortly after was recruited into Solar City, very, very early days. And that just proved to be, what a blessing in my life, not only as an entrepreneur. I was able to grow an incredible company and be very integral into the company going public, as well as the subsequent merger with Tesla. But also professionally and personally, it was transformational in terms of my own wealth. And that's ultimately what led me to starting Inception Financial. Was after I had that exit from Tesla, I was looking to solve my own tax problem. And there was born Inception Financial.
All right. Well, so I was going to delay that a little bit, but let's just get into it. So what were the big challenges you had? You have a big windfall, and you're faced with I have a team-based approach. There are other tax mitigation strategies out there. We use them in conjunction with solar as well. But what was it that really, you have a background, but what is it that really draw you to your strategy, the solar field and renewable energy?
Well, it was because I had deep experience when I was working at Tesla and prior Solar City, that we came up with these financing mechanisms along with all the large banks. US Bank, Morgan Stanley, Goldman, et cetera, are all heavily invested in this asset class. And we were reducing the upfront cost for homeowners by allowing them to simply purchase the electricity and not the actual equipment. And therefore, they had a lower electricity bill. And we just did similar to a mortgage, where we bundled up all of these assets and we sold them off to the banks, who owned them on the balance sheet, by the way. So this was done at the C Corp level, not that they were sharing this with their private clients. All done at the C Corp level, and very elegant and very simple. So I'd known about the strategy, but I had never employed it myself. And it was really me connecting with my now managing partner. His name is Ryan Hamilton. And Ryan just said, "Hey, knucklehead, you should be doing this." And I thought, yeah, marvelous. Why would I not? I know the asset class. I believe in it so much. And it's really kind of a well-kept secret, because most of these large institutions and even corporations like Google, Apple, Walmart, Netflix, Amazon, Target, they're all invested in this asset class. I just never thought about doing it personally. And so I did look at other tax mitigation strategies, but what I found was that most of the strategies out there are just deferral programs. And on a net present value basis, some of them are really great, like buying a jet and then potentially, leasing that jet out when you're not using it, levering it up with a bunch of debt. It's a great use of your money to fly private, reduce the overall cost to fly private, and you do get some tax benefits. But the moment I were to sell a jet, I'd be hit with all that recapture tax. And one of the very attractive things about solar assets is they are an energy asset that are excluded from recapture tax if you own that asset for 5 years. And so when I looked at all of the strategies, looked at oil and gas and things like that, and I think those are incredible investments, but those are just tax efficient investments, right? That can help reduce the earnings I make off of my money. But I was hard pressed to find anything where I could literally redirect the same dollars I was giving to the IRS and use that to buy an asset. And that asset delivered to me underlying tax benefits, which was true tax savings year over year. And then I had an option. At the end of 6 years of ownership, I could either sell it on the open market or I could hold on to it and generate cash flow. But either way, I get zero return with my money to the IRS. Here, I was able to generate return and savings for the family treasury, and I could do that year over year, rely on this strategy. And so it was a no-brainer. And I also just know the asset class so well. What I love about it is no moving pieces. There's no phone calls. It's all done through ACH. And it's, glass on a roof delivering electrons. So I don't have to deal with some of the other investments that I have, like in real estate, which again, very good investments, but they come with their own issues, right? Same with running a restaurant like Jimmy John's. I had employees there, and a host of other issues. Same thing with real estate, broken toilets and phone calls. Here with this asset class, it delivers a predictable yield, but it's very low touch. So all of those things just was a no-brainer for me to do it. And then we realized, hey, there's nobody out there who's really educating the retail clients this exists. And our company really started because I have very close friends of mine who are extremely high net worth entertainment executives. They trust me as the solar expert. They knew what I was doing personally, and they're like, "Hey, we want in." And so I said, "Okay, well, I'll help you." And really, under a consulting arrangement with our first couple clients, we got them going, and that paved the way for us to get out of the proof of concept and say, "This is a legit, real business. There's nobody doing this. We can do this at scale." And here we are, almost 5 years into our fifth year, and we've helped hundreds of clients save literally, tens of millions of dollars in taxes.
Yeah, I would say you glossed over it, but maybe for people that aren't fully in tune with some of the tax code, we probably need to be a little bit more specific. So you mentioned oil and gas, and I'm going to talk about that a little bit. So an oil and gas strategy that we use as part of the ERT group, excuse me, is a deduction. So let's say you put $100,000 into an oil and gas investment. The number is you get about a 93% or a $93,000 loss or deduction on your taxes. And so that reduces your ordinary income. But with the solar, you're talking about tax credits. So why don't you go into the difference between, so the deduction just reduces your income. You're still paying taxes, but what you said was a dollar for dollar exchange. Instead of paying money to Uncle Sam, $1 or $100,000, you're buying $100,000 worth of solar assets. Is that correct?
That's correct. So if I use that same analogy, and I just want to be clear, I think both are great investments, but one is really a tax efficient investment. The way I understand the ones I've looked at with oil and gas, where yes, you get that depreciation deduction, right? If I own a well, and that's great, but I'm investing in that well because I believe it's going to give me a cash on cash return. So if I make 100 grand, that deduction of, let's say 90,000, whatever the number may be, that means that I just pay less in taxes on my overall gains. Great strategy. Love it. Here, this is not about making an investment that then will lower your overall tax obligation on your gains. This is literally taking money after I've done oil and gas and any of these other really nice tax efficient strategies. If I'm left with a tax bill, which most people are, then here's where we can come in and shave the difference. And so what's lovely about our strategy is that it's a complement to anything else people are doing out there. It can sit in a sidecar, right? And just go right in parallel. And the way that works is and I'm going to speak in broad terms, just so your audience really understands, you have a tax obligation to the IRS. So you could instead redirect those tax dollars. So my wife is an executive and she has a W-2, and we've changed the withholdings on her W-4. So there's very little taxes coming out of her paycheck. And now we have this surplus of cash that we didn't have before, right? So it was going to the IRS. We keep that in the family treasury, and we use that to buy our solar systems every single month. I used to pay my taxes because all of my income's through K1. I'd pay it quarterly. I stopped paying quarterly because I didn't need to anymore based on guidance from my CPA. And I simply used that same money that was earmarked to pay those taxes and instead used them to buy our assets. So for our household, there was no impact to our cash flow. Okay. It is a straight redirection of those tax dollars. So let's just keep the math easy. Let's say that I'm going to otherwise owe $100,000 per my household to the IRS. We just redirect that into buying these assets. And then when we file our taxes, again, speaking broadly, we get a $100,000 tax credit. Now, your audience may be thinking, okay, but you're really just pari passu at that point, right? You're net zero. Correct. But what you're getting when you buy these assets is you're getting all of this depreciation benefits as well. And so that depreciation benefit, as you mentioned with oil and gas, is going to be a deduction from all other forms of income, right? So you're going to take your AGI and reduce that down. And we know for every dollar you can reduce income on paper for reporting of taxes. If you're in a 37% tax bracket, and if you're unfortunate to be in California paying 13 or 14% like I do, you're saving 50 cents on every dollar.
Yeah.
So the real power of the strategy is leverage the tax credit to buy the assets. And what you're really buying with those assets and value is all of this depreciation deductions that are going to save you even more on your taxes.
Right. And so over the lifespan, so you mentioned you can, at the end of 6 years, you can either sell this asset or you can continue to use the asset. Which do you do? You know, since you're an expert in this area and keep doing this year after year, month after month?
Yeah, it's a great question. So there are various forms of financing for solar energy. I want to be explicit about that. And so our specific, what I'll call our bread and butter product is what's called a prepaid power purchase agreement. And a power purchase agreement is simply a property owner, whether it's a residential home or say a small business owner, they want to pay for solar electricity. They have decided for various reasons that they don't need to own the physical equipment on the roof. They just want to buy the power. And so there's a power purchase agreement where that property owner could just pay every single month based on the electricity that's generated. There's another form, which is ours, which is called prepaid. And instead of that property owner paying each month, they're going to pay for all 20 years of electricity up front. Now, the whole audience is probably wondering, why would anyone ever want to pay for 20 years of power up front? There's a variety of reasons, but the most simplest answer is it's the single lowest cost option to acquire electricity, not just solar electricity, any form of electricity. So that property owner is incentivized with a large discount on their power. So most of the property owners we're talking to are very sophisticated, and they see this as the most economical way to get electricity for their home. So they prepay all 20 years of power payments up front. What that means is that we then take that income, okay, from that property owner and the power purchase agreement that they signed, and we simply assign that to our clients who end up buying that asset. And so that income is assigned to the LLC that owns the asset along with that contract. Now, we don't actually have to send the actual money into the bank account of our client. That's going to be done through bookkeeping with the CPA, and the IRS allows that. But we're going to take that upfront money and we're going to use that to pay the contractor who's doing the installation. So speaking broadly, the prepayment that the property owners are making is roughly 2/3, Stuart, of the total cost of the asset. And so that other 1/3 is coming from our clients who are just redirecting their tax dollars. So that's important to explain because I'm going to answer your question now about year 6. In the 6th year, per this agreement that the property owner signed, they can buy the solar system back from the owner. So I'm going to put myself in the shoes of the owner as I am. If the property owner wants to buy that solar system back from me, we're going to do a fair market value assessment, and we're going to negotiate that for me and all of our clients, and we're going to broker that transaction. What we tell all of our clients is assume that you're going to sell it back to that property owner for $1. And the reason I'm using $1 is that's a plug. That's the lowest cost we would ever sell it back for. And that's actually very symbiotic because the property owner paid all that money up front plus $1. Now they own it. And I've been able to save considerable money on my taxes. Great arrangement. Now, back to your question. There are going to be some owners that elect not to buy it. And so if they do not buy it back from me, they'll start paying me every single year for maintenance and administrative fees. Now, it's a very nominal fee of roughly, let's call it $300 approximately per household. And my cost to Inception Financial is only about $100 a year per asset. And so I would net roughly $200 per year for every asset I own. Well, if you only own 1 or 2 assets, that's not moving the needle. But like my wife and I own hundreds of these. So it's very accretive. And that's each year we do this, we will receive that type of cash flow year over year. So to answer your question, I hope that the vast majority, if not all, of my property owners elect not to buy it because every single dollar that I make in cash over zero is just more value to my household because I didn't really have to use any of my household money for this. I just redirected tax dollars. So I'm happy to eke out every single dollar I can because it's going to be accretive and I already own these assets. Now, if I was only going to do this one time ever, let's say someone had a big exit, and they're maybe not going to have much income over the next 5 years, then maybe they would hope that every one of their property owners just elects to buy it. But the good news is Inception Financial will find a buyer to help if there's a client who does not want to own these assets after that 6th year. So I know that was a mouthful, but it's a difficult question because there's a lot of nuance there.
Yeah. So, I've seen this strategy being presented to me several times. I've looked at it. When you just went over it, sounds super complicated. We will have, and you do have, explainer videos. We're going to put those explainer videos in the bio below, so you'll be able to review it. Actually, you have diagrams so you can see how the money and cash flow moves in and out. But again, it does sound super complicated. And from a particular investor, you might be thinking right now, oh my God, like real estate, like running a restaurant, there's a lot of work I've got to do, but that's not the case. That's where you guys come in, right?
That's correct. So this has specifically been designed so that the owner of the LLC, the clients who are listening today, they can participate in the business, but it requires maybe, a handful of hours a week. That's it. In doing so, they're able to claim active status in the business, and therefore they can use all of the depreciation and the credits against all forms of income. So this can work active or passive. If for some reason we have a client that is not interested in participating at all, then they can use this strategy just to offset passive. But the vast majority of our clients, they don't mind putting in a handful of hours every week, reading contracts, looking on the portal, looking at the investment, doing their due diligence. And we have the business template that makes this business a very low touch business. But what our clients are doing is essentially setting up a small company. And that small company is now a solar electricity provider, providing electricity to households all across the United States. And we have the template to show everybody how to do it. And we're right there to ensure that the most important aspect of the business, which is the technical side, ensuring that the electricity is being delivered, along with having all the necessary insurance in place, we manage all of that for our clients. So it's a low touch business.
Yeah. Well, so our audience is high net worth family offices. What should they be considering, whether they are, considering oil and gas, considering solar? And it's, as you stated before, it's not an either or. And in fact, usually it's an and. I call it stacking. So we might stack some of these deductions first, and then whatever the tax bill is left over, depending on what their goals are. Do they want to be more charitably minded, more investment minded, what have you? Then we start bringing in tax credit strategies like solar. What should a high net worth or family office be considering thinking about when considering your strategy?
Well, first thing I want everyone to consider is look at it. Take the time. To your point, it sounds like there's a lot of moving pieces, but it's actually really simple at the end of the day. Also realize that it sounds somewhat esoteric. Don't let your fear of the unknown scare you away from looking at this. This is very, very simple. It's well codified. It's been designed by the largest institutions on the planet, and they've been doing it for decades. This is not new. It's just new to most of your audience here that's hearing about it for the first time. I would say we have the great explainer videos, 15 minutes. You watch that, you can go back and rewatch it. We have a whole knowledge center that lists every single tax code and a summary of how it works, why it works. So everyone that's listening can do the research they want on their own time. And then when they're ready, they can set up a call with us so we can actually start doing the planning. We always like to work with every single client's CPA first, so we really understand their true tax situation. I agree that this is an and strategy. It's not an either or. And I say, just give us some time, really look at it. If you're paying taxes, there's a better solution. And not only can you save money at the household level, but also there's a lot of our clients who feel like we're doing some social good out there. Now, most people are making this decision because it's financially motivated. And that's smart, and you should be for your household. But if these other ancillary benefits appeal to you, it can be a double win.
Yeah, we haven't even talked about that. Like, definitely when we're presenting things to clients, I say, hey, there's an oil and gas strategy. Like, I don't really want to be involved in oil and gas. Well, we have Charitable-minded strategies. Okay, there's a solar. Okay, let's do solar. I like that sound of that. And some people really resonate with, hey, instead of moving money to the IRS, I want to move money into renewable energy space and make the world a little bit better place. Even if it is net zero, which it's not, but even if it were, that would be a definite benefit. Can you walk me through a very specific high net worth example of somebody that you had? In recent time, I saw, you probably have hundreds, right? But is there somebody that sticks out to mind that you're like, this really worked out well for them, and it was just a very simple example for people to kind of glom onto?
Absolutely. And let me first state that the tax code here is well established since 1978 and is in place per Congress until 2032. For those listening, I want you to know that this is something you can rely on year over year. And we do have scale. And what's nice about this asset class, because it's predominantly residential solar, we can help somebody who's got a $100,000 tax obligation. We can help someone who's got 10 million. And we do have client profiles that meet both of those. So for anyone listening, we can help right size whatever your tax obligation may be and help with this strategy. I'll just use a very simple example, and this is indicative. So you can just move the decimal points for those who are listening. But if I took $1 million, that's otherwise going to go to the IRS. And I'll use California only because it's the highest. So this is sort of like your best case scenario, if you will. When I say highest, I mean highest income tax. This strategy does work very well. We've got clients in both Florida and Texas where you don't pay taxes. But in a state like California, if you're in the highest tax brackets, you could give $1 million to the IRS or move $1 million into buying solar. After the first year, you're greater than net zero. Okay. Meaning you'll get tax savings in that first year. So you'll get back your $1 million plus. Over the 6 years, and the reason it's 6 years is because these assets benefit from bonus depreciation. And as most people may know, bonus is at 60% this year. That remaining 40% of depreciation you get, you just have to wait your 6 years using the maker's formula. So it takes 6 years to get all the deductions. After 6 years, you'll receive back between tax credits and depreciation value $1.3 million. So another way of saying that is, if you had a $1.3 million tax bill, you could instead buy $1 million worth of solar assets, and the family treasury saves $300,000.
Yeah.
That's in the first 6 years. If you were to hold every asset for the full 20 years, well, that's going to grow. And that would then grow to 1.45 million. And I'm just giving you the numbers that are contracted. That's what we can predict, right? So it's anywhere between, say, a 30% tax savings to as much as a 45% tax savings plus cash return.
Sounds fantastic. Sounds amazing.
We think so.
Yeah, which is why you keep doing it. Are there any risks associated with this that we need to be aware of? Like, you said the tax code is codified till 2032, so we've got some good runway ahead of us, but are there things in the regulation front that could derail this, or is there anything that we should be thinking about that could be problematic?
Yeah, great question. Of course, with anything, there's going to be a degree of risk. I can't say there's zero risk because nothing exists like that. I would say that this is likely one of the most risk-adjusted assets and investments that our clients make. Furthermore, I will say that we have, with our business template and what we offer to our clients, mitigated, I think, the vast, if not all, the risks. But the single, I would say, largest risk that our clients and their CPAs look at is if you want to claim active status in your business and therefore use all of these credits and depreciation against active income, right? So as you know, most everyone on your audience is likely falling into that active category, right? Unless they're getting all their income through LPs. This works great for any of your active income. But in order to do that, there's a favorable piece of code the IRS calls material participation. Specifically, it's the 100-hour rule. It says, if you're engaged 100 hours or more in the business that owns these assets, then you can take all of these tax attributes and use them towards active or passive tax liability. So the risk is the business owner going to put in those hours? What does that really mean? It means that you keep a log, and we provide that log, which has the vast majority of activities. There are ample things to do throughout the calendar year to meet this material participation requirement. That's going to come up really only in the unlikely event of an audit. Fortunately, we don't have a history of anyone being audited, but this is the insurance policy, if you will, that they need to keep on file. That if even a random audit came up, they could say, here's my log, here's all the things I've been doing to show that they've been active. If we had a client that didn't keep a log and was not able to show that evidence to an auditor, well, then that would be a big risk, right? Because if they wanted to claim active benefits, you got to have that log. But as long as people are following the rules, which are well written out by the IRS, you can mitigate that risk by just doing what the IRS allows. This is not some type of tax scheme or loophole. This is just embracing the piece of the tax code that most people don't know about. The other risks we mitigate, there's insurance. So if you had things like a tree limb falling on the system or theft or hailstorm, et cetera, you're going to be covered by multiple insurance policies that we have. We are ensuring that that system is delivering electricity to the property owner through a technical services agreement that we have in place with every owner. So the operational side of the business, like warranty issues, dealing with contractors and property owners, we're dealing with all those headaches on behalf of our clients. So we feel we've done a great job. And certainly personally, I can tell you, going into my 5th year, I'm not getting many phone calls, and my systems are just producing electricity that they're intended to produce.
Yeah. I mean, this does sound like a on paper tax mitigation kind of esoteric strategy, but there are actual solar panels going on actual buildings that people are owning. And what I just heard you say, and I've heard you say it before, you handle all of the on-site management, you help the CPAs with all the paperwork on the filing, you basically take all of the guesswork out of this and work with all of the entities so that the person doing the investment and buying the solar assets really have very little requirements of them other than this 100 hours of material participation, right?
That's correct. The way that we like to speak about that is you're setting up a business, right? Now, it just happens to be a business that's low touch, and clearly the code says it only needs to be 100 hours. So they're not expecting this to be a full-time job, right? They just expect that you're running a legitimate business, which you will, right? You'll have a profit and loss statement, balance sheet that your CPA can put together for you. And any good business owner is going to be doing all the necessary due diligence that they would do before they buy an asset from us. They're going to be looking and going into the portal and inspecting and making sure that the 3-line drawings are there. They're going to make sure there's properties of the physical address. So, okay, you really did sell me something, right? The burden is there. We can demonstrate that by what's in the portal. Every physical address is listed. Every single document that from the moment that property owner agrees to buy the electricity, to designing that asset, to getting that asset installed and permitted, and then operating, it all belongs to our clients, and they have access to every one of those documents. So we feel there are more than enough activities in a calendar year to meet that, we'll call it 2 hours a week requirement, 100 hours throughout the year. But yes, we, like any business would do, the client is outsourcing the technical side of things, because just like when you build a residential building, none of the clients out there are actually putting the roof on or installing the plumbing. That's a technical trade that requires a technical company like us to do that service, and that's what we do.
Yeah, sounds fantastic. You mentioned $10 million, $1 million, 100,000. Is there a minimum where this makes sense to do this or not do this at? Where's the line?
I will say selfishly, like any good company, you I mean, of course, right? Listen, I don't want to represent that we're trying to democratize anything here. That's not really been the goal. We did want to make this available to retail clients because they should be able to enjoy the same benefits these large institutions have been enjoying for decades. But as a business, you want to run efficiently, right? So obviously having fewer clients, more clients allows us to provide that white glove service, right? And to provide the service that our clients expect of us and make it high touch. So to answer your question, I would say that we typically say if you've got a $200,000 or more tax obligation, that's going to really be in the sweet spot. But we have clients that have done 50,000. So, we want to open this up to anybody that may be interested. You grow any business through referrals. So clients that have 50,000 know people that may have, 1 or 2 million. So we don't really talk about minimums per se, but for those family offices or other advisors listening, I'd say 200,000 in tax obligation is a real good sweet spot.
All right. Sounds wonderful. Well, this has been amazingly helpful. I love hearing about this every single time. It becomes more and more powerful every single time I've hear about the strategy. As I said, it does sound complicated. We will list the explainer videos in the resources below, so you'll be able to click on those. Your company's done a wonderful job of creating these explainer videos to help kind of make this a little bit more clear on some of the cash flows, because it can be a little bit complicated when you're looking at it initially, but plenty of time to ask questions and explore, talk to your financial advisors. Jesse, how can we get a hold of you?
Yep, you can just email me at Jesse, Jesse, at inception.financial. So Jesse with an E at inception.financial. You can also go to inception.financial, and there's a link in there in which you can put in your information and someone will contact you back. And I'll just close with just piggybacking what you said, Stuart. Like, I remember a long time ago, one of my close colleagues says, don't be too busy to get rich. Make sure that you're staying focused on the things that are going to, create wealth and also preserve wealth. And to your point, it sounds difficult. I assure you it's not. Once you take the time, watch the videos, it's worth the time. Whether or not you decide to do it, that's a different story. But certainly learning about it, arm yourself with the information, have a phone call with us, and learn how this might be a good benefit for everybody that's listening.
Yeah, absolutely. Well, again, Jesse, thank you so much for your time. I've been your host, Stuart Kruse. I can be reached at stuart@kruseassetmanagement.com, and Kruse is Kruse. You're watching Money Talk Viewpoint, which is a podcast geared towards the high net worth and family offices and those who service those areas. If you are interested in becoming a guest on the show, please reach out to moneytalkviewpoint.org. And again, it's been my pleasure. I'm Stuart Kruse. Welcome to the show, and I hope you had a great time. And we work hard to make you guys and us better every day.